Starting with our shorthand notation, aggregate demand is a function of consumption, investment, government spending, net exports, money, or the nominal money supply, taxes, and the nominal interest rate. Pluses mean if you increase C or I or G or NX or M, all of those things will increase aggregate demand. But if you increase taxes or you increase interest rates, aggregate demand will fall. Hence we put a negative because there's a negative relationship between this and aggregate demand. Now how do we graph aggregate demand? We're going to graph aggregate demand in PY. P is the price level and Y is real GDP. Okay? And we can think of aggregate demand as the demand for real GDP, real production and real goods and services. Nothing here can tell us about the slope, but it turns out that the slope of aggregate demand is negative. Why is it negative? It has to do with more deep reasons in terms of higher price level, meaning lower real stocks of wealth and money to be spent, which then lowers aggregate demand. If you increase the price level from here up to here, you get a decline in the amount of aggregate demand. It's not the typical microeconomic story, so be careful. But what I want to show here is how this thing shifts. So it's very simple. For a given price level, and a given aggregate demand, at this same level of prices for all the goods and services in the economy, if for some reason the Fed increases the money supply, that will increase net exports, investment, consumption, and increase aggregate demand. That would move aggregate demand out to the right. So for that same price, we get more aggregate demand. Okay? Similarly, any of these could increase. Government could just increase its spending, and that would increase aggregate demand. Shifting this out to the right, for every price level, it would move to the right. Net exports there could be a lot of demand for our goods and services abroad, or there could just be optimism in the economy, causing an increase in consumption and or investment. The things that are going to shift aggregate demand to the left are if we get an increase in either of these things, increasing taxes or increasing interest rates will lower aggregate demand, shifting the curve to the left. In this case, for the same price level, there's more taxes, so you have less money to spend, so consumption and investments fell. So for the same prices, there's less aggregate demand in the economy. Similarly for interest rates. Now, be careful, because if you lower taxes or you lower interest rates, it'll move this thing to the right. If you raise taxes or raise interest rates, it'll move it to the left. Similarly, if you cut the money supply, it could move this to the left. So if any of these go up, this shifts to the right. If any of these goes down, it shifts to the left. They move with aggregate demand. Aggregate demand moves in the opposite direction of those two, and that's how it shifts back and forth, and we'll use that for basic analysis.